Okay, I'm going to tell you the secret to trading stock. Would you like to know the secret to trading stock? Don't freaking do it. What does trading stock mean? It means buying it and then turning around and selling it. It's a short-term kind of thing. Here's the problem. Number one, first of all, you have to pick the stock, right? What makes you think you're smarter than everybody else in the market that you have this magical ability to pick stocks over and above all these people who do it for a living? And the geeks with their supercomputers. It's a losing game. And it's definitely, so let's say half your trades were positive and half were negative. You'd still lose because of transactions costs. Because even if you're on Robinhood, even if you're on Robinhood, you've still got the bid-ask spread. That's still a transactions cost. So don't do that. What should you do instead? Invest. And the only piece of investment advice that I could ever give you that I know you won't come back and kick me 30 years from now is buy the S&P 500 ETF because it's well diversified and it's tax efficient. There's all sorts of amazing things about that. So there's your investment advice for today. Any questions? Okay, let's get back to, or let's start talking about dividends and other payouts. So we've been talking about capital structure. Does anyone have any idea how dividends and payouts relates to capital structure? What are the two things that we have in our capital structure? Think back to the balance sheet. Assets is equal to liabilities and owner's equity. Now, the payouts, are they going to affect our liabilities? No. Are they going to affect equity?
Yes.
Yeah, how do they affect equity?
They reduce equity.
Okay, and especially
Reduce retained earnings.
Yeah, there you go. Okay, are you ready?
Yeah.
Boom. Okay, so if we look at, when we talked about the pecking order, we talked about the internal generated equity of the firm. That internal generated equity is the non-distributed earnings of the firm. If you want to have more money to invest, then you distribute less. If you don't have necessarily projects to invest in, then maybe you want to distribute more. But this definitely impacts, these payouts definitely impact the amount of equity that we have to invest. And we're going to be talking about two kinds of payouts. We're going to be talking about dividends, and we're going to be talking about share repurchases. And I'm going to tell you the pros and cons of both. Let's start with the different types of dividends. First of all, let's talk about cash dividends. And the one that most of you are familiar with is the regular cash dividend. A regular cash dividend is just a periodic payment made by the firm. And it's typically every quarter, which is every 3 months. There are a few weird companies that make their dividends every 6 months, but for the most part, it's every 3 months. And this is a payment that they typically make. Now, are they required to make dividend payments? No, they have to be declared. Each and every single dividend has to be declared by the firm's board of directors before it becomes a liability of the firm. And what that allows us to do is if we find ourselves in financial trouble, we can cut the dividend, or we can just not pay a dividend whatsoever. We can omit a dividend. Okay, now that's for your regular operations. But what do you think happens when we find ourselves with extra cash on our hands that we want to distribute to the shareholders? Should we raise our regular cash dividend if we can't continue that higher level? No. In fact, we know that if we raise it and we can't sustain it, we're going to have to lower it. And what's the market going to do to us for that? Mr. Payouts, what's the market going to do to us?
Not be happy with it.
Not be happy with it. In fact, we say there's an asymmetric response. When you boost the dividend, you get a nice little pat on the back there. But when you cut the dividend back to where it was, you get a huge kick in the ass. And so there's an asymmetric response. So we want to avoid cutting our regular cash dividend if at all possible. So how can I, through a dividend, distribute this extra cash? Well, we could do something called an extra cash dividend. And so assume that we've got $5 that we want to pay out. Our regular cash dividend is 1, and we've got an extra 4 that we want to pay out. What we'll do is we will declare our regular cash dividend of $1, and then we will declare an extra or special dividend of $4. And in that way, we're not developing the expectation among the investors that we're going to continue paying $5 every quarter. The extreme case of a special or an extra cash dividend is the liquidating dividend. Imagine that you've got a company that has a temporary purpose. For instance, that you are doing the catering for the next Olympics, whenever it's going to be in the U.S. So you might put together the company, you do all the business, at the end you would sell all the assets, and then you would pay a liquidating dividend back to your initial investors. Oh, he's a little late.
I was taking an exam.
Oh no! So I never let students go past the end of class, and so I would never throw you into being late to another class. So tell me who this professor is, I will have a talk with them. I'm kidding, don't, okay. So back to the story. A liquidating dividend is after we've liquidated all the assets, we've paid off all the liabilities, everything that's left belongs to who?
The stock.
Yeah, the stockholders. And so what we're going to do is pay that money back to them. So common reason for a liquidating dividend would be a firm that has its assets acquired by another firm. So this is different than a merger or acquisition where someone buys the stock of the firm. Typically, for those things to go through, they have to be supported by a majority, a supermajority of the target firm's shareholders. So we're talking about 2/3 or 3/4 of them plus 1 share. If we can't get that to work as a bidding firm, we can always make a bid for the assets of the firm. And that only has to be approved by 50% plus 1 of the shareholders. So then we can buy the assets. We don't get stuck with the employees. The only thing we're getting there is the assets. So the company that does the selling of the assets at the end, what do they have? They've got a ticker symbol, they've got a corporate headquarters, and they've got a huge pile of cash. What should they do? Sell the corporate headquarters and pay a liquidating dividend out to those shareholders. Because after all, whose money was it to begin with? The shareholders. And so the liquidating dividend not only pays out the money that we've earned and have not yet distributed, it also pays back the initial capital investment of the shareholders, or that's the general idea. Questions? Okay, now we'll talk about stock dividends. So companies will sometimes declare these stock dividends. Let's say it's a 2% dividend, and they've got 100,000 shares outstanding, and you personally own 100 shares of that stock. After the stock dividend, now you will own 102 shares. Do you think you're any better off? No, because what we're doing is we're taking the equity of the firm, and instead of dividing it by 100,000 shares, now we're dividing it by 102,000 shares. And what you'll see is if you take 100 times the old stock price, it's going to be exactly equal to 102 times the new stock price, because the new stock price is going to be lower because each share represents a smaller flow of the future cash flows of the firm. And so stock dividends are actually smoke and mirrors. They don't actually do anything to the value of the firm. In fact, they don't. Not only do they not improve the value of the firm, they actually decrease the value of the firm slightly. And here's why. I'm going to have to go out there now and do a bunch of record keeping to update people's accounts with this new amount of stock that they have. It was even worse back in the days when people had stock certificates. I can remember my dad getting a stock certificate for like 2 shares for a company that he owned that had done a stock dividend. Totally worthless and cost money to do. So I don't understand why people still do it, but there it is. And then sometimes companies will declare a dividend in kind. So whatever the company does or produces, that's what they're going to give to their shareholders as a little dividend in kind. And so at one point, Wrigley's Gum sent out a box of chewing gum. Another example, this crematoria. Do you guys know what a crematoria is?
Just burns the bodies.
Yeah, so if you don't want to be food for worms, you can always get put in an oven and turned into ash. And so the Dundee Crematoria offers shareholders discounted cremations. Now, will the shareholder ever get direct benefit of that dividend? No. In theory, who might?
Family members.
Yeah, the family members, right? Okay, so that's a dividend in kind. Of these, the regular cash dividend is the most common, and the dividend in kind would be the least common. So let's talk about how we describe dividends. So we can talk about them on a per share basis. And if I just say that the dividend is $1.36 per share, is that good or bad?
Just depends on.
Yeah, it really depends, right? So here are a couple of questions you should ask. Number one is, what was the dividend last time? And if the last dividend was $1.98, and now we're, what did I say, $1.64? Is that good news or bad news? It's bad news. But what if the last dividend was $1.25? Then that's good news. And so you have to have comparison against the previous dividend. The other thing is the number of shares outstanding, because after all, the total amount of dividend paid out is going to be the per share dividend amount times the total number of shares outstanding. We can also talk about the dividend yield. And that's where we take the dividend and divide it by the price. And you've probably seen this written before as D1 over P0. That's a terrible marker. D1 over P0. What do you think D1 means?
Next dividend.
Yeah, the next dividend, the dividend to be paid at time 1. And the P0 is what?
Current price.
Yeah, the current price. So basically what we're saying is, what am I getting for my investment of P0 at time 0? What will I be getting at time 1? So this is the way we calculate dividend yield. Now, here's the question. Certainly today we know what P0 is. Can anyone tell me how you could learn P0 for a stock right now?
Check the price.
Yeah, check the share price, right? Boom, you've got it. Do you know with certainty what the dividend is going to be 1 year from today? Nope. So this is at best a guess, right? But we do know about dividends. They tend to be sticky, and so there is a good chance that the dividend is going to be the same or higher than it is today. And we'll get to a little bit more of why dividends are sticky. And then we have the dividend payout. This is where you take the dividend per share and divide it by the earnings per share. And this is exactly the same as taking the total dividend paid and dividing by the net income. In other words, what percentage of the net income are we paying out as a dividend? And you're going to see that that varies widely. If a firm is growing and has lots of positive NPV projects, what do you think their dividend payout would look like? Good?
Say what?
Okay, a firm has got lots of projects.
Oh.
They're early in their life cycle, they've got lots of great projects. What is their dividend payout going to look like?
0.
Yeah, it should be 0, right? Because they're going to use that internal equity to help grow the firm. However, what if you are a cash cow? Do you guys know what a cash cow is? It's just a firm that has no positive NPV projects, no growth opportunities. If we don't have any growth opportunities at the firm whatsoever, should we be retaining any of the earnings? No, we've got nothing to invest in. And so at that point, our payout, our dividend payout should be 100%. And so in between there, though, you've got lots of firms that pay out a portion of their net income as dividends, but not all of it. In fact, I would say the majority of firms that do pay dividends fit in between that 0 and 1. Questions? So here is the procedure for a cash dividend. Remember, we said that dividends are not a liability of the firm until declared by the board of directors. The date upon which the board of directors declares it is known as the declaration date. And that sets things in motion. The next date that gets decided is actually that record date. In fact, the declaration will say that we're going to pay $1 per share to shareholders of record from on July 30th. And so that July 30th would be the record date. And right here, it's what, January 30th. Now, if you actually want to get that dividend, you have to buy the stock before the ex-dividend date. The ex-dividend date is the first date that which the stock trades without the benefit of the dividend. Now, historically, that has been 2 days before the date of record. But somewhere around 2022, they changed it to 1 day. Now, when I say they, who am I talking about? Who might be the ones deciding this sort of thing?
Just the companies themselves?
Not the companies themselves.
SEC.
That would be my first guess. But the actual arbiters of this are the stock exchanges. And here's why it's changed. Settlement used to be a paper affair, and it took 2 days. And so when I would buy stock, I would not receive a confirmation of my trade. I didn't get it the next day. I got it 2 days, so it would be another 24 hours. Now, when I trade, if I trade today, I will receive my confirmation tomorrow. And so the confirmation process has been reduced from 2 days to 1. And what that means is now we are able to know with certainty who the shareholders are 1 day in advance of the date of record instead of 2 days in advance of the date of record. And so if you're asked about this out on the street, of course the answer is now it's 1 day. The ex-dividend date is 1 day before the date of record. For the purposes of the only practice problem that I give you on this, go ahead and assume 2 days, which was the standard up until 2022. Let me say that one more time. For everything except for the practice question, assume 1 day, but for the practice question, assume 2 days, like we had in the old days. Now, before the ex-dividend date, by the way, ex-dividend, you can think of it being like ex-wife. Ex-wife means without wife. Ex-dividend means without dividend. So on the ex-dividend day, that stock is trading without the dividend. Before that time, after the declaration date and before the ex-dividend date, we say that it is cum dividend. Cum means with. So magna cum laude means something with honors, I think. So cum means with. You hardly ever hear anybody talking about cum dividend, but you hear about ex-dividend all the time. And then finally we have the payment date. That's the date that the checks are sent out to the shareholders. Now, do you think people actually send a lot of hard checks anymore? No, for the most part, it's direct deposit. And so if you have your dividend direct deposited, that's the day that you will receive it. By the way, which is better, having it direct deposited or having it show up in your mailbox?
Direct deposit.
Yeah, direct deposit. Have you guys, my mailman's great, but have you saw a lot of the postal help lately? Yeah, my mailman's great, but occasionally we have a substitute, and I will get crap for my neighbors. Now, I'm a nice neighbor, I take it to them, but do you think that everybody does that? No. So try to get all your dividend checks direct deposited if you can. Questions? Oh, by the way, that 2 days or 1 day, those are business days. And so if the date of record is on a Monday, then the 2 days would push you back to Thursday of the prior week. 1 day would push you back to Friday of the prior week. Let's talk about what happens to stock price when the dividend gets paid. And we need to start with the concept that the company is actually worth less after the dividend is paid. And the way we can think of that is that the company is sitting here with, let's say, $100,000 in cash, and now they pay that cash out as a dividend. Not only does it decrease the cash on the books, what does it do to the equity? Yeah, it's going to reduce the equity as well. And so as a result, what we see is that the total value of the firm falls. Yet we have the same number of shares outstanding, therefore the price per share must drop. In a world without taxes, the price would drop by exactly the amount of the dividend. In a world without taxes, the price would drop by exactly the amount of the dividend. However, we live in a world with taxes. And so the way dividends are taxed presently is that if your adjustable gross income is like less than $49,000, then you pay 0 taxes. And then there's a big group of people who pay 15% taxes on their dividends. And then there's a group that pays 20%. So the overwhelming majority of shareholders are probably paying the 15% dividend. As a result, we'll just take that as our tax rate for the overall investing body. If the firm pays out a dividend of $1, how much do the shareholders actually get?
0.
The tax rate is 15%. I'm going to pay you $1. How much of that dollar do you get to keep? 85 cents. Therefore, how much is that dividend actually worth to a shareholder? 85 cents. And so it turns out that the price of the shares will actually drop not by $1, but by 85 cents, because that's the change of the value of the shares to the shareholders based on that dividend being paid out. That's a little hard to wrap your head around at first, and I didn't believe it until I read the study that proved it. So someone went out there and actually looked at what happens to share price reactions or share price when a dividend gets paid, and that's exactly what happens. Now, when does that happen? So we've got the day before the ex-dividend date, we are trading at the higher level, and the stock closes for the market closes for the day, and then the next morning the stock opens lower by 85 cents on average for a $1 dividend. Did you know that stocks can open lower than they close? Yeah, for one thing, we've got this dividend thing going on. For another thing, is it possible that news comes in overnight? Yeah. So think about oil companies. If you're an oil company and everybody, the market closes out And then in the morning you wake up early and you figure out that Israel has bombed Iran. What happens to the price of oil around the world? It goes up. What happens to the share price of the oil companies when the stock market opens the next morning? Boop! They open much higher than they closed the prior evening. Questions? So when we were talking about capital structure, we talked about some arguments that led us to conclude that capital structure was irrelevant. Do you remember what irrelevant means?
Doesn't matter.
Yeah, it doesn't matter. It doesn't matter. And in fact, it's our same friends, Modigliani and Miller, that have come up with this dividend irrelevance proposition. And so it's easy to kind of show that the dividend policy is irrelevant if we assume no taxes, no transactions costs, a lot of the same kinds of things that we assumed for capital structure irrelevance. And we're going to use the same arguments that we used to show capital structure irrelevance, in this case, instead of homemade leverage, it'll be homemade dividends. And we'll talk about how you could actually undo a dividend that you did not want. But of course, once again, this only happens in a world without taxes. Now, where does dividend irrelevance lead us to? It tells us that a company cannot increase the value of its firm by simply starting to pay a dividend, because of this irrelevance and the ability to create homemade dividends. There's nothing that the company can do for us that we cannot do for ourselves, just like our capital structure irrelevance arguments. And so this leads us to the conclusion that dividend policy has no impact on firm value. Now we're going to see when we start to relax some of these things that there may be arguments for why dividends will or won't matter, but under the assumptions that we've made previously, it's just not going to matter. So here is our example of homemade dividends. Bianchi is a $42 stock about to pay a $2 cash dividend. Remember, we are in a world without taxes. What's that stock going to be worth after they pay the dividend? 40. Bob, investor, owns 80 shares and he wants a $3 dividend. Do you think Bob can call the company up and say, well, I'd rather have a $3 dividend? No, they're going to tell Bob where to get off. So Bob figures out this homemade dividend strategy. Instead of trying to get this $3 dividend, he's going to accept the $2 dividend and he's going to sell 2 shares ex-dividend. Selling 2 shares ex-dividend means selling them at $40 a piece. He's going to receive $80 in cash for having sold his shares. And that's exactly what he would have gotten if the firm had paid $3. And so now he's receiving $240 in cash instead of the $160 in cash that he would have received under just the $2 dividend. Let's look at the value, though, of the holdings. If Bob had held on to all of his shares and only accepted the $2 dividend, he would have stock holdings versus $3,200. And so if we add the value of his stock and the value of the cash that he's received together, we have $3,360. Now let's look at the other side. Now Bob has 78 shares after he's made his homemade $3 dividend. 78 times 40 is 3,120. So if we add the value of Bob's stock holdings to the amount of cash that he got from the $2 dividend plus his share sale, and that's going to be $240, that brings us to $3,360. Was Bob's wealth any different as a result of having undertaken this homemade dividend? No, it doesn't change the value of its holdings at all. Therefore, in the same situation with the same assumptions, the company issuing a greater dividend doesn't impact the value overall of it. Doesn't increase shareholder wealth any. Doesn't decrease it, but it does not increase it. Questions? So, homemade dividends don't create any additional value, therefore dividends are irrelevant in the world with all of our assumptions. And we'll just skip over that because I just walked through it already. So now let's talk about dividends and investment policy. One of the things that we assumed when we were talking about capital structure is that these financing options and opportunities do not impact our investment decisions. And what we want to see here in dividends and investment policy, we want to see that we are never going to issue a dividend. We're never going to forego a positive NPV project in favor of issuing a dividend. It doesn't make any sense to forego this positive NPV project to increase a dividend or to pay one for the first time. What's the goal of financial management?
Maximize shareholder value.
Maximize shareholder wealth. And so I've got $10 here. And I can either hand that $10 to the shareholders right now, or I can invest that $10 in a project that has a $17 positive NPV. Which would the shareholders rather I do?
Positive.
Yeah, invest in the positive NPV project. And so that's why we should say we never increase a dividend or forgo a project to do that, a positive NPV project. And so one of our underlying assumptions for this dividend irrelevance argument is that the investment decisions are made at the firm ahead of time. And that's exactly the same assumption we made when establishing capital structure irrelevance. Now we're going to move on and talk about the repurchase of stock. We said basically there were two ways you can hand back money to the shareholders. Number one was through dividends. Number two is through repurchases. And we're going to see that repurchases and dividends, we should actually use them in different situations. We said that the market will punish us for cutting a dividend, so we should never raise a dividend unless we are certain we can maintain that higher level of cash flow. And so how can we disperse this extra money if we've got extra one-time money? How could we disperse it? Well, we could do one of those special dividends that's on top of the regular dividend, or we could go out into the market and repurchase shares. And when people announce share repurchase plans, they never give they usually do not give a deadline over the time frame that they're going to have to do that. And so if something happens in the meantime that they need to hold on to that cash for a bit longer, they still have it to work with, as opposed to declaring a dividend. Because once we declare a dividend, it becomes a liability of the firm and it must be paid. So we've got this extra cash. Let's see what happens here. Now, this picture is really not the best. The reported earnings is the blue line, and it is the most jagged line up here. And the red line are dividends, and dividends are the smoothest line up here. The other line, the green line, are the share repurchases or buybacks. And here's what I want you to notice. The buybacks go up when cash flow goes up, and they go down when cash flow goes down. And so what we see is a lot of that volatility from the cash flow, the cash flow, the way the firms are handling that is through share repurchases, not through increasing the dividend, because they don't want to increase the dividend and then have to decrease it later on because the market will punish them. Any questions? You just sold a division. You have an extra $10 million. Should you increase your regular cash dividend or do a share repurchase? Mr. Rowlands.
Share repurchase.
Yeah, share repurchase. Why?
It's like a one-off event.
Yeah, it's a one-off event. Guys, I know you know the answers here. It's a shame I have to call people out. Please feel free to answer if you know what you're talking about. And if you don't, have you ever seen me really embarrass someone for not knowing the answer? No. There's nothing to lose here. These are extraordinarily low stakes. Now let's talk about a stock repurchase versus a dividend. So we've got a firm that wishes to distribute $100,000 to its shareholders. We've got the balance sheet right here. We've got $150,000 in cash. We have $850,000 in other assets, and we have no debt. Since we have no debt, we know that the equity has to be equal to the assets of the firm. So we know the equity is $1 million, and therefore our balance sheet balances out. We have 100,000 shares outstanding, and our price, therefore, is that 1 million value of the firm divided by 100,000 shares gives us $10 per share. Now, in our first example, we are going to distribute that 100,000 as a cash dividend. What's going to happen to the cash account on the balance sheet?
Decreases by 100,000.
Yeah, it's going to decrease by 100,000. And what does that do to the value of the assets of the firm?
Decrease by 100,000.
Yeah, they're going to decrease by 100,000 also. Now, what does that mean has to happen to liabilities plus owner's equity?
It also decrease by the same amount.
Also going to decrease by the same amount, and it's going to come out of the equity. It never comes out of the debt. It always comes out of the equity. And so we know the value of the equity at the firm is going to drop to $900,000. Now we still have 100,000 shares outstanding. 900,000 divided by 100,000 gives us a new share price of $9 per share. And that makes all the sense in the world because we took $100,000 of dividends divided out by 100,000 shares. That's basically $1 per share. And in a world without taxes, when a $10 per share firm pays $1 dividend, the share price is going to drop to $9. So that's what things are going to look like in the event of a dividend. But what if we do a stock repurchase instead? Well, the cash is still going to drop down, and the equity, therefore, is also going to drop down. So far, everything is identical. But what's different? How did we use that $100,000? We repurchased 10,000 shares of stock. If we had 100,000 shares of stock outstanding before, and then we repurchased 10,000, how many do we have outstanding now?
90.
Yeah, we got 90,000 shares outstanding. And so we're going to take our new equity value of 900,000 and divide by our new number of shares of 90,000 and figure out that our shares are still worth $10 per share. And so financially, right up until we figure out share value, these are identical. Right now, would you prefer one over the other? Not really. Now we're going to get to some reasons why you might, but from what we've talked about so far, there's no reason to prefer one over the other. let's talk about some things that might make these, might give us a preference for one over the other in the real world. First of all, flexibility for shareholders. If I am a shareholder in a firm and they declare a dividend, do I get a choice as to whether I receive that dividend or not? I get no choice. And so that dividend's coming whether I need it or not. Now you might say, well, it's not a big deal. You can just reinvest it. And in a world without taxes and transactions costs, that's a perfectly lovely answer. However, do we have taxes in the real world? Yeah. Do we have transactions costs in the real world? Yes. And so people might prefer not to receive the dividend. However, if they do need the money, what can they do if they're not getting a dividend? They can sell shares. And so basically anybody who wants money can take advantage of the share repurchase to sell their shares. Or they could just sell their shares at any time in the market. And so that gives shareholders flexibility for when they receive the cash. The second thing that we see is that it keeps the stock price higher. Now, at first, it sounds like that shouldn't matter, and to the average shareholder, it doesn't matter. But what if you are an executive of the firm and you have received executive stock options? Would you care about the value of the stock then? Yeah, let's think about this one. Let's say the stock was trading at $5 per share a year ago, and the board of directors told the managers, we will give you options to buy the shares at $7 per share 1 year from now. What's the only way that they make any money? You guys know enough about options? How this works? Yeah, the share price has to go above 7 in order for them to be able to make money on this deal. Assume that the firm pays out the dividend of $1. So 1 year from now, the share price is $9. How much does the executive make on each of their stock options? $9 minus $7 is $2. And that sounds pretty good. But if we had done a repurchase instead of the dividend, what would the shares be trading at?
10.
Yeah, 10. What's 10 minus 7? 3. That's a 50% improvement over the $2 per share. So are you starting to see why the executives would prefer for the firm to do a repurchase versus a dividend? It's lining their pockets. Okay, now there's an argument about offsetting dilution. By the way, if we go out and issue additional shares, we have diluted the original shareholders of the firm. When we have stock options for executives, if we do not repurchase, when we deliver those new shares to the executives, now the number of shares outstanding goes up. And so the argument goes, well, we should repurchase the same amount of shares that we are basically generating new to hand out to the executives, and it will maintain us with the same number of shares. So from a mathematical perspective, it absolutely does achieve the offsetting of that dilution. Another good reason to do a stock buyback is if you think the firm is undervalued. If the firm is currently trading at $8 per share, but I think it's worth $10 per share, it makes all the sense in the world for me to go out and spend that $8 per share to get those shares that are worth more. There was a time period in the 1980s when General Motors' best investment was repurchasing its own stock because it did not have the kind of growth opportunities that, say, Toyota and Honda did. And so at the time, that was the very best thing they could do with that money. It kind of sends a signal to the market. So who has the most information about the firm? The managers or the investors? The managers. And who is making the recommendations to the board about repurchases or not? The managers. And so when the managers are putting forward this idea of repurchasing the stock, it puts out a message to the market that perhaps the stock is undervalued. It's exactly the opposite message that we said issuing new stock sent. What message did we say issuing new stock sent? That your stock is overvalued, right? And so we see typically when companies announce a repurchasing plan, their share price goes up. Part of the reason it does is because of this information component. The insiders think this stock is worth more than the current price. And then we have tax benefits. If I receive a dividend, it's taxable income to me for that period. I cannot get away from it. So whatever taxes the current tax regime says that I owe, I must pay. However, what about if they're doing repurchases? If they're doing repurchases, I don't have to sell my shares. So that's the first thing, is the timing argument. If I don't need the cash, I don't want the dividend because I would have to pay the tax. If I don't want the cash, I would much rather the firm do a repurchase so I could hold off on paying those taxes until a later date. And furthermore, when I spend $100,000 on a dividend, that entire amount is taxable. But if I use $100,000 to buy back shares, the people who sell their shares, they don't owe taxes on that entire $100,000. They only owe taxes on the capital gains. And so let's assume that our average shareholder bought the stock at 6, and now we're repurchasing it for 10. They'll only be paying taxes on 4 out of those $10 per share, meaning that they'll only be paying 40% taxes on 40% as much of that cash dividend as they would be, of that cash repurchase as they would be versus if we paid it as a dividend. And so it is more tax efficient to distribute money back to the shareholders through repurchases. Any questions? So let's talk about some of the assumptions that we had to make to get here. First of all, we've already mentioned no taxes and no transaction costs, but a third one is no uncertainty. Let's talk about why uncertainty comes into play here. Have you ever heard the expression, a bird in the hand is better than 2 in the bush? Yeah, so hopefully your grandma said that to you. And what does it mean? It means if you have possession of something, one bird, you are better off than if you just see 2 over there in the bush. What's possible about the birds in the bush? What could they do before you got to them?
Fly.
Yeah, they might fly away. And in fact, they probably will. That's uncertainty, right? We don't know whether or not the birds are going to fly away. I could let the one bird go in hopes of being able to capture the 2, but there's uncertainty as to whether I will be able to get one or both birds. And so the bird in the hand argument says, I want these scumbag managers to pay that dividend out, because at least if they pay me that money in a dividend, I know they will not be wasting the money. So that's where uncertainty comes into play. If you could be certain that the managers would only make positive NPV investments, then you wouldn't be concerned about that. But because of that uncertainty about the future and about human behavior, then there's an argument to be made for, well, hey, we'd rather have our dividends now. So at the United States, by the way, you can scratch through that as of 2019 because I checked it right before class and it's still the same. For the first group of people, you've got 0%, and then for most people, you've got 15%, and then for your top earners, you've got 20% taxes, and that's the same on both capital gains and dividends. When I was a young man investing in the beginning, I looked purely for capital gains because capital gains were taxed at a lower rate. But even if the tax rate is the same between those two, you may find people desiring the repurchase instead because of that flexibility that we discussed and the tax efficiency. Let's see. Capital gains can be deferred, so your tax rate on dividends is actually greater than the effective tax rate on capital gains. Another thing you can do with capital gains is to offset your capital gains. So I've been holding on to, so I bought stock for, this is an anniversary present for my wife, way back when, before Martha Stewart went to prison. She had a publicly held company and she did an IPO. My wife's like, I really want some of that stock. So being the romantic that I am, that's what I got her for her anniversary. Now, I am still holding on to the stock of whatever that company is today. It's worth damn near nothing. If I had a big capital gain in a given year, what could I do? I could go ahead and sell that crappy stock and use the capital losses to offset those capital gains for the purposes of my taxes. So this is another reason that I might prefer a capital gain to a dividend. Questions? Okay. Now, in a world without taxes and transaction costs, it is perfectly fine for a company to issue new stock to pay a dividend. However, we do live in a world with taxes and transactions costs. So let's talk about if I wanted to pay out $100,000 to my shareholders and I did not have the cash, what could I do? I could go out and sell stock and then use the proceeds to pay a dividend to the investors. Now, you guys have already got that suspicious look on your faces, then you should. And here's why. First of all, when I issue new stock, I have to go through someone called an underwriter. Underwriter is an investment banker that helps us take those new shares to market, and they require payment for their efforts, typically 7.5% of the amount that I am issuing. That's why it's good to be an investment banker, right? Especially if someone's going out and raising $1 million or $100 million. If they're raising $100 million, how much is your cut? $7.5 million. Okay, so now we're down. We went out and raised $100,000 in stock, but we had to pay $7,500 to the investment bank. So now we're down to $92,500. And we can pay that out to our investors. They've already lost 7.5 cents on the dollar. And now what are they going to have to do? They're going to have to turn around and pay taxes on that. Because any time that the dividend comes through, it shows up on your taxes. And so money is going to flow from the government, or to the government. And so now they're left with even less money. And so in a world without taxes or transaction costs, basically you could make this circle continuously and it would be totally irrelevant, wouldn't matter in the least. But the fact that we have taxes and transactions costs means that now dividend policy is relevant because it has costs. Questions? Okay. So what if we've got excess cash? What is excess cash? We also call it free cash flow. It's the cash that's coming in that's over and above that needed to invest in all positive NPV projects. And so who does that money belong to?
Stockholders?
Yeah, it belongs to the stockholders. And what we should see is that firms would either pay that out as a dividend or would do a stock repurchase. But instead, sometimes we see managers pursuing these alternatives to a dividend. And the first one would be to select additional capital budgeting projects. Now remember that we've said they've already funded all of the positive NPV projects. What does that mean about the remaining projects?
They're all negative.
Yeah, they're all negative. And so let's assume that there was a project that had a negative IRR of 2%. The managers might say, well, if I pay this money out to the shareholders, they're going to lose 15%, but if I put it into this project, they're only going to lose 2%. Maybe, maybe not, that's a decent argument. I would say, I would rather you go ahead and give me the cash, most likely through doing a repurchase, because then I don't have to accept that payment and I don't have to incur that 15% loss. By the way, what kinds of additional projects do you think managers are going to choose? Are managers humans? People are scumbags. And so the kinds of projects you'll see managers getting involved in are ones that bring benefit to the managers. For example, there is a corporation called Eaton. Eaton makes all sorts of industrial goods dedicated to power transmission. So it's hydraulic, electric, all sorts of things like that. And all of their divisions are all about power transmission, except for one, the golf grips division. Anybody here play golf? Mr. Buhite, you don't play golf? Oh, you play golf, Mr. Volker. What is a golf grip?
Like the top of the golf.
Yeah, that squishy part at the top where you put your hands. Now, why in the world do you think these people who know not jack squat about golf grip business would want to buy that division?
Instead of getting cheaper.
Okay, so they might, they're getting free samples from their company.
It's cool.
It's cool. It gets even worse. Now that we have a golf grips division, where can we have our meetings for our board of directors?
Golf course.
Hilton Head, the old course in St. Andrews. There's all sorts of lovely golf courses that we can visit. Oh, and by the way, we have to show the board our new products for the golf grips division. That's why we take the sacrifice, make the sacrifice of going to these golf courses, is just so we can show the board of directors what a great job we're doing with the golf grips division. Do you think the board of directors buys into that? Oh, hell yeah, they play golf too, right? Do you see that now that there's also agency problems among the directors as well as the managers? And so the kinds of things you might see happening here with these slightly negative NPV projects would be things that these managers would enjoy for themselves. And then we have the acquiring of other companies. So there's this paper called Roll 1986, it's the hubris hypothesis. And basically, he looks at all of the studies up to 1986 on acquisitions. And he shows that the net gains from acquisitions are non-positives. Now let's talk about, there's two terms there, net gains. If you take, by the way, the stock of the target firm always goes up in the event of an acquisition because you have to offer a premium to get the shareholders to sell. So they're always going to be better off. What Roll is asking is if we add the gains to the target shareholders to the gains or losses from the bidding firm, is that result positive? And if it is, then at least we have created value. But what Roll finds is that in the overwhelming majority, the gains are non-positive. In other words, the amount that the target shareholders gain is more than offset by what the bidding shareholders lose. Do we then, knowing that, are we really interested in having these managers go out and make acquisitions? I'm not. By the way, do you think managers overestimate the true value of an acquisition? Yeah. So I'll give you an example. I was working for Halliburton, and we were buying a company called Dresser. And we were told, I was a Halliburton guy, we were told, those people at Dresser don't know their ass from a hole in the ground. We're going to sweep in there with our superior Halliburton management techniques, and we'll be able to turn that place around and make all sorts of additional profit. And so on my 28th birthday, now it's a little before then, I had to lay off 6 of my guys, and then they told me I was going to go down to this Dresser plant and, bring them into the fold. So I was on the vanguard of bringing the superior Halliburton management techniques to Dresser. But when I got there, I found out something very shocking. They were actually smart. They were actually doing a good job. And the things that we knew that they were doing that we thought were weird, they had good reasons for doing them. And in fact, in some areas, they were actually better than we were. So, do you think that we were able to get as much value out of that acquisition as our managers thought we would? No, we couldn't make near the improvements that they thought we could because they had totally underestimated the target firm. So even though someone could make an argument that you're going to lose less if I make a slightly bad acquisition than if you have to go pay taxes, my answer is, well, you're going to lose more than you think. And so I would argue against doing that. And then there is the purchasing of financial assets. These are things like stocks and bonds. So there's extra money laying around at the firm, and instead of giving it back to the shareholders, they say, well, wait a minute. We have the only reason this argument works is if they've got a lower tax rate. So the corporate tax rate is lower than the personal rate. It makes sense for them to hold on to that money and invest it in the firm because that minimizes the taxes that get lost. However, in the real world, do you think that companies typically have a lower tax rate than your personal tax rate? Especially not those people that are paying 0% on their dividends, right? And 0% on their capital gains. There's no number that they could roll out that was lower than 0, that is their tax rate. And so I would tell them, don't do that. Go ahead and pay that money out to the shareholders. If they want to buy bonds, they will. If they want to buy those stocks, they will. And by the way, what would you rather have? You as an investor choosing which stocks you get invested in, or the CEO of a company deciding what shares you get invested in? I'd rather make up my own mind. Does that make sense? And then finally, to repurchase shares. So that's my favorite alternative to the dividend is the repurchase shares. It's more tax efficient. It gives the investors flexibility, and you don't have to give up your shares or take on any cash if you don't want to. Questions? So, in the presence of personal taxes, we've already said that they should not issue stock to pay a dividend. And we talked about the seeking alternative uses. When it says though personal taxes mitigate against the payment of dividends, what does mitigate mean? If I'm going to mitigate the impact of a fire, yeah, we're going to lower the impact of the fire. So here we're going to mitigate against, so we're going to lower our dividend payment because of those taxes. the taxes are not sufficient to lead firms to eliminate all dividends. And so we have this argument that we shouldn't pay dividends to the shareholders because after all, they're just going to lose some of that money to the government. But we see that that argument doesn't fly with everyone because we still see a tremendous number of firms paying dividends, and we see a lot of money being paid out as dividends. Under the current tax laws, shareholders generally prefer a repurchase to a dividend for the reasons I've already talked about. The entire amount of the dividend is taxable versus only the capital gains portion of the repurchase, and you don't even have to participate in the repurchase if you don't want to. Questions? Now, so far, we have not made a really good argument for why a firm should have high dividend payout. But here we have some reasons people might. And the first is desire for current income. Now, in a world without taxes and transactions costs, it would be easy enough to just sell a little bit of your shares now and then. However, once we start getting transactions costs, especially back in the 1970s and 80s, I can remember my dad having to pay $300 to $400 every time he bought or sold stock. And it didn't matter whether it was 10 shares or 100 shares or 1,000 shares. The commission was high. And so homemade dividends didn't make a lot of sense back then. Plus, dividends were taxed as ordinary income, so they were taxed at a higher rate. So it didn't make a lot of sense, dividends were taxed at a higher rate, but you get by without the transactions cost if they actually paid you the dividend. So he was saving that huge transaction cost, even though it was kind of hurting him on the taxes. Assume now, though, that we've got a situation with zero taxes on dividends and capital gains, and we have no transactions costs. You might still find people that were interested in receiving dividends, and it's a behavioral finance explanation. Which do you feel better about spending? The earnings on your retirement or the capital that you invested?
Earnings.
Yeah, the extra, right? The new stuff. And people, this is a way that people can prevent themselves, because if I were doing homemade dividends and instead of selling 2 shares this time, maybe I'm like, well, hey, maybe I'll sell 3 shares or I'll sell 5 shares. And before long, it's kind of like when you buy a box of cookies and you take it home intending only to eat 5. What typically happens? Yeah, more than 5, usually the whole damn box, right? And then you feel like crap. And so we see the same behavioral problem with people and their money. But somehow, if people can put the money away and forget about it and just receive those dividend checks, then they don't feel that they will be nearly as likely to go out there and sell those shares and lose their investment. Does that make sense? So there is a real behavioral reason behind this. Then we have agency costs. Remember we said that managers love to have this free cash flow laying around that they can spend. And so one of the things that dividends do is get that money away from the managers. And so they could, a repurchase could do it. But a repurchase is not as big of a credible certification. When I raise the dividends, I'm more or less saying we're going to maintain that. Now I can cut it if I have to, but I'm going to be punished. When I go out and say that we're going to repurchase shares, it's not nearly the strong commitment. By raising dividends, managers are committing not to waste that money. And that brings value to the shareholders. And then we have the information content in the dividend that gets announced. If I announce the same dividend that I have been for the last 10 years, what is your assumption about the future prospects of the firm?
It's going to stay constant.
Yeah, it's going to stay constant. What if things have improved? What if we are now at a higher permanent level of cash flows? I can signal that I, as a manager, believe that this new level of cash flows is higher by raising the dividend. And so when I do that, the share price goes up because that's a positive signal. Now, is that a better or worse signal than going on television and saying, oh yeah, our future cash flows are looking great? Which one's more credible? Yeah, the dividends, right? Have you ever heard the expression, put your money where your mouth is? That's what raising dividends does. Repurchases are not as strong a signal because we're not promising that we're going to do this all within a certain amount of time. In fact, it might not get all done at all. And so you'll see a dividend increase gets a nice bump in the stock price, a repurchase gets a smaller bump in the stock price. Once again, the reason that signaling is important is because of information asymmetry. Who has more information, the managers or the investors? The managers. And the managers are the ones that are making the recommendation to the board of directors about what kind of dividend we should pay out. Are there any questions?